Good morning. It's Thursday, June 25th. I'm Brad Shively with Capital Management Corporation. We are pleased to have Michael Barker with us today to talk about the future of the estate tax. Michael is a partner at McGuire Woods and is a member of the firm's Fiduciary Advisory Service Practices Group, specializing in all things related to estate and taxes. Before we get started, just wanted to highlight to our audience that we'll be in listen-only mode today. So if someone has a question, you can go ahead and type it. There's a little box down below that says questions, and you go ahead and type that in, and we will get to that in our Q&A piece here. Michael's going to run through a brief overview on the estate tax future there, and then we will open up to questions. So Michael, the floor is yours.
Thanks so much, Brad. Thanks everybody for circling up on this. I really appreciate folks' interest here. And as Brad said, I'm Michael Barker. I'm a estate planning lawyer here in Richmond at McGuire Woods, and wanted to just start by sort of acknowledging that the elephant in the room here is that there are more important things to be talking about right now than the estate tax, as we sit here sort of in the midst of two significant national crises. And so just wanted to acknowledge that I think we recognize that, but appreciate everyone's interest in this topic, and the show will go on and we'll talk about estate taxes. I hope that I recognize this format is not ideal for a discussion, but I do hope that you will go ahead and type in your questions. I think that it's structured that I'll be able to see those questions as they pop up, and I certainly welcome interruptions and thoughts and comments. And so as you have any thoughts or reactions to my comments this morning, I'm happy to sort of stop and address your thoughts and comments or questions on that. So we're just as a brief overview, as Brad said, we're sort of going to take this in two chunks. One, we'll start with an overview of the estate tax, where things sit right now. Secondly, we'll talk about maybe what might happen in the future, and then third, sort of what are we doing about the estate tax now? What are clients doing to take advantage of opportunities related to the estate tax? So when we talk about the estate tax, I've sort of given you on this slide some very basic facts related to the estate tax. But before sort of diving into what's the current state of the law, I think maybe a little background might be helpful in terms of, will the estate tax laws change in the future? From the title of my presentation, I suggest to you that the estate tax is going to change in the future. And I'll tell you why I think that. The history of the estate tax is really interesting, at least for tax nerds like me, and maybe for some of you as well. I mean, the estate tax was enacted during the Woodrow Wilson administration in 1916 as part of his sort of progressive new freedom agenda. And then those rules stayed intact from 1916 all the way until 1954. And what I want to get at here is that the estate tax rules used to change once in a generation. It used to be that there would be a whole generation would go by with no changes to the estate tax. But now what we're seeing is not changing the estate tax rules once in a generation. We're seeing a change once in a political cycle. So the estate tax was enacted in 1916, modified in 1954 with the Big Tax Act during the Eisenhower administration, big tax overhaul another 30 years later during the Reagan administration in 86, and then a big tax overhaul in 2001 during the Bush tax cuts. So sort of a once in a generation experience. But since 2001, the estate tax rules have changed in 2001, 2009, 2010, 2012, 2017, and they're scheduled to change again in 2025. And so what I wanted to talk a little bit about today is, we think the estate tax rules are going to change, so let's sort of, we can dive into that a little bit. And maybe one of the things you're thinking about is, why are the estate tax rules changing so frequently when they didn't before? Of course, nobody knows for sure, of course, but I think that, you know, some folks would say that income inequality is a legitimate issue that needs to be addressed in our society. economists have identified some risks according to, related to wealth accumulation in certain segments of the population. In fact, there was a New York Times article just yesterday pushing for estate tax reforms from a sort of an ideological perspective. So maybe there's a legitimate need to address that issue, or maybe it's something that just reacts to people, and so politicians are using it to get to their base. But one reason or another, it seems here to stay that at least for the near term, there's going to be some changes from time to time on the estate tax. So here you've got on this slide the current state of the law. The gift and estate tax exemption is currently over $11.5 million per person, which means over $23 million for a married couple. And what that means is if the exclusion amount's $11.5 million, that means when you die, the first $11.5 million of your assets are not subject to the estate tax. So that means for a married couple, $23 million is not subject to the estate tax. That means that less than 1% of the population is paying the estate tax. But those that do pay the estate tax pay it at a pretty high rate, 40% tax rate on all amounts that of a person's net worth over that exclusion amount. And the reason that it sits at 11.5 million now relates to the 2017 Tax Act. Sometimes that's called the Tax Cuts and Jobs Act. That's the President Trump's tax act from a few years ago, which doubled the exclusion amount. It was sitting at just over 5.5 million, and now it's at over 11.5 million indexed for inflation. So it'll continue to rise. So what's going to happen in the future? Well, the estate tax exclusion amount is set to drop down back to $5 million on December 31st of 2025. That $5 million is also indexed for inflation, so it'll be more like 6 million. So folks who have an $11.5 million exclusion amount now are going to have, unless Congress changes the law before then, on January 1st of 2026, you'll wake up with only a $6 million or similar number exclusion amount, or $12 million for a married couple. But so much depends on who wins upcoming elections between now and then, and I'm certainly not going to guess. Elections are unpredictable these days, so I'm not a prognosticator, and so I'm not going to guess as to who's going to win. But we can sort of talk a little bit about what do the various parties, what's their objectives with respect to the estate tax. And by the way, just as a disclaimer, when I talk about Republicans and Democrats for these purposes, I'm talking about Republicans and Democrats in Congress. I recognize that and understand that most humans are permitted to have nuanced opinions about things, but oftentimes in Congress, our leaders are not. So quite simply, we know what the Republicans think about the estate tax. The GOP would eliminate it. And there's been a bill introduced every year in recent memories to permanently repeal the estate tax. I think most recently was HR 521, the Permanently Repeal the Estate Tax Act. The Republicans, when they had control in 2017, elected not to fully repeal. And I think that was probably a fairly savvy move by the Trump administration, because it's pretty easy to criticize a person of his nature and wealth to eliminate the estate tax. And they were able to get 99% of the way there by jumping up the exclusion amounts without having to take the political heat. So we know what the Republicans think writ large. What do the Democrats think? And we're in campaign season, so there's been a lot of ideas thrown around. Now that we know that Joe Biden is the nominee, he's a little more conservative on tax issues than his counterparts were in the primary. Certainly the left or more progressive wing of the party was very focused on tax matters, income inequality matters, estate tax issues, particularly Senators Warren and Sanders. And I think had they been the nominee, maybe you would see more continued focus on tax policy. But Joe Biden is really interesting in the way that he's sort of talked about income tax issues and estate tax issues. And one of my favorite stories is that when he announced his run for president, when he did his presidential bid rally last year. He did it to the firefighters union, and so he had a nice sort of setup there in front of a group of firefighters. And as he was trying to whip the crowd into a frenzy and get them all fired up, the thing that he talked about was income tax policy. And I think his big pitch for the presidency was, let's eliminate the step up in basis. And I always say there's nothing that gets people more excited than Internal Revenue Code Section 1014. So I think that was probably a savvy move on his part. He talks about increasing capital gains rate for the wealthy, for people who have a adjusted gross income over $1 million a year. He says let's double the capital gains rate for those people. There was lots of talk in the campaign about a wealth tax. I'd be certainly happy to dive into the wealth tax if that would be something that folks are interested in. But I think the primary proponents of the wealth tax were Senators Sanders and Warren. What I think was most interesting about the wealth tax is that it sort of seems like an idea that would be dead on arrival. It sort of seemed like an idea that would be too progressive for a majority of Americans. But what's interesting is that the latest polls, at least the ones that I saw, which now are maybe 6 months old, showed that a majority of Americans supported a wealth tax. And that was true according to the data across gender lines, across race lines, geography, age, support for the wealth tax. There was only one group that was staunchly opposed to the wealth tax, and that group was Republican men with college degrees. Republican men with college degrees opposed the wealth tax, but it picked up a lot more traction than I think a lot of folks expected. And I think if Senator Warren turns out to be the vice presidential nominee, that maybe that'll come back into the discussion, although certainly we have more pressing issues in society now than we had during the presidential debates earlier this year. Joe Biden's approach to the estate tax is, not surprisingly, he wants to go back to 2009 levels when he was a vice president. And effectively what that means is an exclusion amount of $3.5 million or $7 million for a married couple, increasing the rate from 40% to 45%. That the $3.5 million and 45% was the Obama administration's proposal pretty consistently throughout. And they made some concessions after negotiations with the Republican-held Congress in the 2010 and 2012 tax acts to make it a $5 million exemption index for inflation at that time. But their hope was always shooting for the $3.5 million at 45%. So what's the big idea? The big idea is, when clients ask me what's going to happen to the estate tax if the Democrats win, my answer is always the question, well, why did they win? Did they win because the electorate had had enough of Donald Trump? That's a possibility. Did they win because the Democratic candidates were more charismatic? That seems unlikely. Did they win because Americans believe income inequality is a big social issue to be addressed? And if the latter, I don't think we should count out, especially if Elizabeth Warren is on the ticket. If they win, that it would be sort of viewed as a mandate seeking sweeping changes for tax reform. But given where we are in society now, those issues may or may not be deemed to be the biggest issues facing us. Seeing no questions pop up yet on that topic, I'll move to, and please, if you have some, type them in, and I'd be happy to address them. I'll move a little bit to what types of planning are clients doing now to take advantage of the estate tax rules. And so the question is 2025 going to sort of be like 2012 all over again? And what I mean is, in 2012, at the end of 2012, the exemption was supposed to drop down from 5 million down back to 1 million, where it was in the 2001 Tax Act. And that didn't happen because Congress changed the law. But a lot of folks did a lot of planning in 2011 and 2012 because they were concerned about losing an exemption amount. And I wonder whether 2025 is going to be the same circumstance, or will it be sooner, maybe 2021, if there's uh, a blue wave, so to speak, in the elections. So what are we doing now? I mean, the short answer is accelerating wealth transfer. I mean, I never want to overstate things, but I do believe it's probably true that there has literally never been a better opportunity to transfer assets to a lower generation than it is right now. With a lifetime gift tax exclusion amount of $11.5 million, there's a ton of resources to use. The interest rates are at all-time lows, and we've got, in certain circumstances, market values of assets pretty low. We certainly did a few months ago when the market crashed in March. I know some, financial advisors and analysts have some concerns about valuations of um, assets in the market now, and I'd be interested in Brad's thoughts on that. But some folks say there are certain assets you can find that are still really undervalued, or if there's another correction in the market or crash in the market in the coming months for a variety of reasons, then we may have uh, undervalued assets again, which are the perfect type of assets to gift, because the name of the game in gift planning is appreciation, right? Two things that the clients are focused on in this current environment. One is, I want to use up my exemption before it goes away. So I've got 5.5 or $6 million of exemption that's going to go away. So I want to use it now by making gifts to my children, grandchildren, or other beneficiaries. And then when I'm thinking about, once I've made that decision, now I got to decide what assets to gift. And the name of the game is always appreciation, because it doesn't do you any good to give away an asset that's not going to go up in value, because you'd rather just hold it until your death, because at your death you can get the step up in basis that Joe Biden was talking about attempting to eliminate for certain segments of the population. Um, so when we're talking about gift planning, we're talking about finding assets that are going to grow in value. Maybe that's because the market value of them went down. Maybe it's because we're going to find some ways to take valuation discounts to get built-in appreciation, right? If you want an asset that's going to go up 5% a year, that's a good asset to gift. But if you can depress the value by 30 or 35%, now you've just given yourself an extra 6, 7 years of growth. And so taking opportunities to find valuation discounts, either by using LLCs or by taking other steps to depress values, is a good planning opportunity. And obviously, I'm happy to go into any of those strategies in detail, but I know we've got just a short time this morning. So, I mean, as I say, typically what clients think about is, when we're talking about valuation discounts, you sort of jump right into, oh, if I slide assets into an LLC, now the interest in the LLC is probably worth less than the interest in the underlying assets, because the LLC is going to have limitations on transfer and limitations on marketability, which inherently push its value down. But there are lots of other ways to think about discount type planning or gift type planning, because, as I said, interest rates are at an all-time low. I mean, for the IRS interest rate for a 3-year loan is 0.18%, or for a 9-year loan is 0.43%. And those are as low as they get. I mean, if you think about the simplest type of estate planning you could do, a parent loans a child $1 million for 9 years, right? We can do a 9-year note at 0.43%. So we loan $1 million. Now let's say, just for by way of an example, that the child takes that $1 million, invests it in some stock, and gets 5% of growth a year. After 9 years, that 5%, that's what, $450,000? And so after you pay back at that really low interest rate of 0.4%, now you're still, what, $400,000 to the good? So the parent has effectively moved $400,000 that would have otherwise been in his or her estate for estate tax purposes down to the child's level, tax-free, all because interest rates are so low, and the market's still done overall pretty well. So there's a lot of opportunity there. Um, Similarly, when the rates are low, there's various types of planning that involve what I call hurdle rate planning, like GRATs are a good example. Um, a grantor retained annuity trust is a trust where you put in assets, and over the course of a 2 or 3 year or whatever year period you want, they come back to you. So you put them in and you take them back, and whatever sort of growth happens within the trust passes down to the kids tax free. It's not a gift because I put $1 million in and I took $1 million out, but the growth at the end of that 2 year period over and above that amount passes down to the kids tax free. I mean, simple things like that. When interest rates are really high, that type of planning doesn't work because the IRS says, well, you've got to take some interest when you do a GRAT. So right now, the applicable interest rate for GRATs is 0.6%. And I think Brad and others in his industry would tell you, we're pretty sure we can get you 0.6% or more. And so a lot of clients are doing GRATs these days. Similarly with charitable lead trusts, I sometimes call charitable lead trusts, I call them GRATs for charity. For people who have philanthropic objectives, you can have a trust that pays certain amounts to charity over time, and at the end of the period, whatever's left goes down to the kids tax free. It's the same kind of idea. And because the rates are so low and there's opportunity for appreciation, it can really be some powerful planning. Wanted to pause for questions if there are any. I haven't seen any pop up yet, but if anybody has any questions, please go ahead and type them in. Brad, am I missing any, or have there not been any?
You know what? I got one here around, and maybe you can walk through this again. I think there's a question about the difference between the gift tax exemption versus the estate tax exemption, which obviously are two different things there and different limits there, obviously. So maybe you can walk through how someone could also give a gift tax or give a gift to a child or a beneficiary, and then how that would apply to the estate tax.
Good question, and I'm sorry that I didn't make that more clear at the beginning. Under the current law, the estate and gift tax exemption is unified. It's one exemption. So I've got $11.5 million that I can either use during my lifetime for gifts, or whatever is left that I don't use up in gifts during my lifetime applies against my estate. So if I've got a $20 million estate, I can give away during my lifetime $11.5 million, at which point, the remaining $8.5 million that's in my estate will be subject to the estate tax at 40%. Or if I've got an $11.5 million exemption and $20 million, if I give away, call it $1.5 million, then when I die, I'll have, say, 18.5 left, and I can apply that $10 million against it of remaining exemption. So in the same way, I'm still paying 40% on the remaining 8.5 million. So it sort of ends up in the same way. The reason that folks are thinking about accelerating and using the exemption as a gift tax exemption and not waiting until death is a couple of reasons. One, you can really, particularly if you've got a long life expectancy, you can give an asset now and you can give it away at $5 million of value. And by the time you die, it may have $20, $30 million of value. So you've given away all that growth down, and that's all passed tax-free at the next generation and is never subject to further gift or estate tax. And so that's where that opportunity lies. And the other reason, as I say, that folks are accelerating their use is because the exemption may go down. And so, and in all likelihood, it will. And so it's scheduled to go down in 2025. And so folks are saying, well, I've got a 5-year period now where I want to use it or potentially lose it.
Okay. And once again, if you have a question, please type it in. You're talking about the elimination of the step up in value, and what kind of, if that was to happen, what would you be doing right now to try to get around that? And
Yeah.
maybe it's just accelerating your gifts right now. I don't know. What would you be doing though?
No, good question. So first, I'll say that I think that eliminating the step up in basis is probably, and again, not a political commentator or person who makes guesses as to that, but it seems to me um, a pretty unlikely piece of legislation, at least in the current environment. And the reason I think that is because all of us benefit from the um, step up in basis. And I think that the people who benefit the most are probably middle class people who inherit, a $7,000 marketable securities account from grandma, and they can sell that and not have to pay capital gains tax at all. And so, if it was going to happen, it would, I think, happen. It would have to be some sort of exclusion or exemption amount, because otherwise it would be a huge middle class and even lower class tax hike, which is probably not palatable for much of the community. If it were to go away, then there's no downside anymore to gifts, right? Right now, the downside to gifts is if you hold on to the asset, you can get a step up in basis upon your death. But if you give it away, the recipient receives it with your income tax basis. So that's why when we're thinking about making gifts, we're thinking about gifting assets that are going to appreciate, and we're thinking about gifting high basis assets. I was seeing another question pop up that said children, but I'm having trouble seeing exactly what that
Yeah,
question is.
it's comment on a parent or grandparent setting up an account using the Uniform Gift to Minors Act. Is there a better tax way to get money to the children?
So that's a great question. One of the, and sometimes those are called uniform transfers to minors accounts, or UTMA or UTMA. An UTMA account is simply a custodian account because under the law, people under the age of 18 are not permitted to own property. And so you've got to have a custodian to hold their assets for them. Sometimes our clients that are making small gifts to kids will make gifts to UTMA accounts. But that's pretty rare. Most clients think that a trust is a better approach. A UTMA account at best can stretch until the beneficiary is 21, or in some jurisdictions 25. And a lot of people say if they're going to make significant gifts to minors, 18 or 21 or 25 is a pretty immature age for a person to come into a bunch of money that they can control. So oftentimes most clients will use a trust for that child's benefit so that the assets can be controlled by somebody else to make distributions for the benefit of that beneficiary until they reach an age of maturity, at which point maybe they can become their own trustee, or maybe they can even pull the assets out. But with a trust, you can hold the assets in for the beneficiary's lifetime or for whatever age or period you determine. So a lot of clients will say, pay it out when the beneficiary reaches age 40. I still don't like those types of things because whatever age people inevitably pick as the age of maturity oftentimes coincides with the age of divorce. And so, folks that are really interested on maintaining the assets in the family line, I think a lifetime trust where the beneficiary gets to become their own trustee upon reaching a certain age, and so at some point gets control but never has to pull it out of the trust, tends to be the better way to do it. UTMA accounts are just too dangerous because somebody's going to turn 18 and they're going to, come into the $700,000 you gave them. Are you going to inhibit their growth? Are they going to still go through college with the same amount of effort that they would if it wasn't there? Are they going to make immature spending decisions at those young ages? So I tend to think that those custodian accounts can be good for little gifts, birthday gifts and that type of thing, but are not generally good for any type of sophisticated or substantial planning.
Another question for you, Michael, around inherited IRAs, potentially. Obviously, the legislation's been passed Would you be doing something else with IRAs? Obviously you talked a lot about appreciation, and we like to talk a lot from our side about compounding and the power of it.
Yep.
With the new rules, that's kind of puts a little crimp in compounding, right? So, just wanted to, with IRAs, what's the best thing you should be doing with your IRAs, since they're going to put a cap on the length of time?
Yeah, so the legislation you're referring to is the Secure Act, and the Secure Act sort of did two things. It extended the period by which, so you don't have to take distributions upon reaching age 70 and a half anymore. You can extend that time by a couple of years. So that's a tax benefit for taxpayers. But then the cost is that the inheritors, other than a spouse, can no longer extend the IRA and take the payments over their life expectancy, but instead are subject to a 10-year limitation. So I still think that the same planning approach makes the most sense, which is for married individuals where the goal is to benefit the spouse, leaving the IRA to the spouse so it can be rolled over at the spouse's level still is the best approach. For folks who do not have a spouse and desire to leave it to children, the children are going to have to take it out over a 10-year period. It's not clear at this point under the law, and I think some clarification will be coming. Do you have to take it out over 10 years by taking a distribution every year, or is it just going to be as long as you pull it out after 9 years and 364 days, you're fine? That's not clear yet, and I think we'll get some confirmation of what those rules are. But a lot of times what clients are doing for fairly substantial IRAs, IRAs of professionals, doctors and lawyers, and with big retirement accounts, a lot of times what their beneficiary designations say: to my spouse, if my spouse is surviving; if my spouse doesn't survive me, then to the children in equal shares, subject to the trust. And because I still think the downside of putting an IRA in a trust before was that you could unknowingly or unwittingly cause the IRA not to be able to be stretched out over the beneficiary's lifetime. That's less likely to happen now, as we know it's a 10-year period. And so having the trust structure around it to provide more asset protection and more protection from the beneficiary themselves still, I think, is a good plan. So I think that's what most folks are thinking about when they think about IRAs right now.
Got another question here around can you set up a trust to grandchildren with parents as a trustee if all the children are financially stable? Does that create issues among children over time in your experience?
Can you set up a trust to grandchildren with parents as trustee? Yes, and you can that as long as that's not a problem. You can even set up a trust to grandchildren with the grandchildren as trustees if they're mature and financially stable. Does that create issues among the children over time? Meaning that now you've got a child who's still his parents' trustee? Most folks, most folks say, go ahead.
No, go ahead. Yeah, I think you got it. Yep.
Yeah, so I think most folks would say, if we're talking about young grandchildren, naming the parent as trustee is probably the most common thing that people do. It's a good approach. The parent can be the trustee. The parent will know what makes sense for distributions for the benefit of the child. And even as the child is, in young adulthood, that still makes sense. At some point, most clients say, I don't want to be in charge of my child's money anymore. And maybe that's when the parent is 75 and the kid is 45, or maybe it's some other age. But at some point, the natural progression, if the child is developing and maturing in a healthy way, is that the grandchild will eventually take over as trustee of his or her own trust. But you never know how folks are going to develop, and it's a hard conversation to have with clients to say that your grandchildren may have a tough time with a variety of things, whether it's addiction or other things, and having somebody else serve as trustee to protect that can be really valuable. I see.
Michael, Another question, kind of more specific, is if you had a single asset, let's say like a vacation home, and three children's families. So something like that where you're passing down an asset. Does that make sense?
Yeah, no, absolutely. It's a single asset or family home inheritance can be a challenge. Um, and oftentimes the biggest challenge that we see is that the patriarch or matriarch's generation values a certain property more than the other generations, or that certain individuals within the family have, at the children's level, call it, one of the children lives nearby and visits the beach house all the time. The other kids live in California and they don't use it or care about it. And they wonder why they're paying, a third of the expenses on it. What we typically do in those circumstances is there's a lot of planning techniques that make sense. But if you just don't know what it's going to be and you want to build in flexibility, the best approach is to give buyout opportunities, because that way the people that are using it can buy it out from the people that are not. And you don't saddle uh, some family members with expenses that they don't want, because oftentimes these types of properties have significant carrying costs. And so when those can be divided, it's really helpful and healthy, but only if there's a modicum of fairness surrounding that. So what a lot of people do in that circumstance is say, we'll leave it to, all three kids in this example and their families, but we'll put in really specific and thoughtful buyout provisions or other ways to move the asset where it needs to go.
I think with that, we will probably put an end to this. And I really want to thank you, Michael, for your time and your thoughts here. It's very insightful. And with that, we will end this here, unless you have any final thoughts, Michael.
No, I'm appreciative of the opportunity. I mean, I think that folks who aren't thinking about gift and estate tax planning are ones who are thinking about shoring up their estate plans. I mean, with the being at home more, I think folks have extra bandwidth right now, and so able to focus on estate planning in ways that they haven't before. And so, clients are thinking about life insurance and thinking about their wills and their advanced medical directives and their powers of attorney and those types of things, which I think makes a lot of sense during these times. So, I'm always available to talk to folks, and I think if folks have more questions, I'd be glad to take them. I'm around today and over the summer, and be happy to connect as appropriate.
Well, great. I really appreciate it, and thank you for everyone for dialing in this morning. So thank you, and we'll end it right here. So take care, and everyone have a great weekend.